All right, so we're going to talk a little bit about life insurance, and I want to educate just a little bit about life insurance and probably bring about some understanding and perspectives that you may not have known, some of the history, and try to clarify some things about life insurance and how that is sold. Um, one thing that I find is most people, when you bring up the topic of life insurance, the one thing that they think about is death benefit, and that brings up the thought a lot of people don't want to think about. They go, the bad thing about that is you've got to die in order for there to be a benefit, and I don't really want to think about that because that means something happened that was bad. And so they think in round numbers of death benefit, 500,000, it might be $1 million, it might be 2 million, it might be, 250,000, but they're thinking I need to go out and buy a death benefit so that I can put some protection in place for my family if something happens, to me or my spouse, and that's important, but it's not a discussion that people like to think about. One thing that they're totally unaware of most times when I talk to them is that they're unaware that there is a minimum price that can be paid for a life insurance death benefit, and there is a maximum price that can be paid for a life insurance death benefit. And they go, oh, I've heard of cheaper insurance and more expensive insurance, cheaper insurance being things like term insurance. Now, what they might be aware, the minimum price is determined by an insurance company. That insurance company looks at their price setting. They look at cost of maintaining that policy. They look at the likelihood of paying out a death benefit based on actuarial science, based on health exams, and they can price out a policy that makes it profitable for the insurance company. In fact, minimum priced insurance is the most profitable for insurance companies, and the reasoning is that 98.5% of all term policies expire before the person expires. Therefore, that's money in the bank for the insurance company. But what would really shock you is if you understand that the maximum price that you could pay for a life insurance death benefit is determined by the government. Now, you pause right there and you scratch your head a little bit and you go, why does the government determine the maximum price that could be paid? Well, let me explain a little bit. It wasn't always this way. In fact, for hundreds of years, wealthy individuals would buy a life insurance policy. They would buy a specific death benefit, and then they would dump a tremendous amount of dollars into that policy, and that would create living benefit components, and it would create a lot of tax advantages. We'll talk about that in a minute. But what you'll see is historically there came about a change, and this maximum came about, and you'll see kind of the pieces come together on the puzzle, because that maximum came about as the government saw something else. So in between the minimum and maximum, there's an infinite product design ability. There's an ability to engineer and change the difference between minimum and maximum, and so raising that maximum line. Now, what you'll find is that maximum came about in the 1980s. Now, let's look at history just a little bit. And in the 80s, you had financial crisis around the country. You had the stock market was in the dumps. You had real estate coming absolutely unglued. In fact, stuff you couldn't hardly sell a house and get rid of it if you wanted to, and largely because interest rates were at double-digit rates. They were you'd go get a house mortgage, and you were fortunate if you could get a 15 or 18% interest rate on a 30-year mortgage. Very expensive interest. There was a bond crash, bond bubble, they call it, and the bond market was coming unglued. And so what happened, the stock market is down in the slumps, and the government got together and they said, hey, we ought to invest into the stock market and kind of prop this thing up, get the economy boosted and going again. And it was quickly pointed out that it's illegal for the government to invest into the stock market. Well, you pause and you see something that happens right there, because in the 1980s, the government came out with what I call government partnership retirement plans. Those are qualified plans. Those are tax-deferred plans. Those are plans that allow you to put retirement dollars into things like IRAs, 401k, SEP, 403b. Those are places that you can defer taxes, which means to defer taxes means you're not going to pay tax now. You're postponing the tax and the tax calculation to a future rate and date. Now, that future rate is not calculated yet, right? And so most people are told, well, you know, right now you're making money, earning money, and so in the future at retirement, you should be at a much lower tax bracket, right? Well, when you think about inflation, do you think that it's going to take more dollars or less dollars to live on in the future? I mean, the government just quadrupled the amount of dollars in the monetary system with QE1, QE2, QE3, QE4. Do you think that that could have an inflationary effect that would cause us to need to spend more dollars to have the same lifestyle in the future? Yes. And so we may spend more at retirement than what we're spending and earning now, right? And what tax bracket will you be in at retirement? Well, we were told that we would be in a lower tax bracket, but if it takes more income to have the same lifestyle in the future, we may be at a higher tax bracket in the future. In fact, what is even more concerning is what deductions will you have when you go to take your money out at retirement? Well, at retirement, we hope that we have our mortgage paid off so we won't have an interest tax deduction. We hope that we don't have child dependents living at home, right? So we hope to not have child dependent tax deductions. So we may actually have less tax deductions at retirement than we have now. It would be this discussion of postponing the tax would be like asking a farmer, would you rather pay the tax on one truckload of seed that you take out to plant in the field and not pay any tax on the harvest, or would you rather skip the tax on that one truckload of seed and go out and plant it and instead pay tax on the hundreds of truckloads that you take out of your field as a harvest at the end of the year? Now, what would the farmer response be to that? He sees far enough into the future that he knows that paying tax on the one truckload of seed makes a whole lot more sense than paying tax on the harvest. But when you get a little bit of a glimpse, what you notice is that the government could not invest their dollars into the stock market to prop up the economy. So instead, they got individuals to invest the government's dollars for them into the stock market, propping up the economy. And not only did the individual invest their dollars and the government's dollars, who pays the fees? Trading fees, management costs, transaction costs, selling fees. Who pays the fees on all those dollars in that fund, that IRA, that mutual fund, the 401k, the SEP? Who pays the fees? The client pays the fees for their dollars, and they also pay the fees for the government's dollars. in that transaction because of that deferred plan. Now, that's pretty good for the government, but I just like you to look at this because right at that time, the government was really pushing this agenda of having people put money into qualified plans. And right at that time, a life insurance company came out with a full-page ad on the front of Wall Street Journal, and they had this big picture of Uncle Sam. He's not your uncle, actually. And they said, call us, we'll show you how to cheat the IRS. Now, ding, ding, ding. That got the attention of some guys over here at a government shop, and they went, what? What are they talking about? They call up this life insurance company. The life insurance company quickly explained that, well, gosh, if you buy a life insurance policy, you can dump a ton of cash in there, and you can use it like a retirement plan, and you could grow that money tax-free that's in that life insurance policy, and you can have non-age restrictive access to that cash value, and you can take loans out of that policy and have tax-free use of that money, and you could spend from that by withdrawals of the basis, or you can take loans from that policy and have tax-free retirement income. And gosh, whatever you don't spend in your lifetime will stack up on top of the death benefit that you had bought and be multiplied and pass tax-free to your beneficiaries. So you can spend down what you want, but whatever you don't spend passes tax-free. And, you know, if you say tax-free, 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 tax-free that many times, well, gosh, it gets the government's attention. It gets the Internal Revenue Service's attention, and they went, wait a second here. That sounds like they're using life insurance contracts like an investment and a safe place to park money and grow their money and get all these tax advantages that we didn't really intend, but, I mean, life insurance has. And they kind of were a little bit upset about that. They said, you know what, we need to make a maximum that can be paid for a given death benefit. And if they exceed that maximum, we need to treat it not like life insurance, but like an investment. And the penalty for exceeding that maximum would be that it would be called a modified endowment contract. And exceeding that maximum penalizes that life insurance contract by treating it like a qualified plan or a tax-deferred plan, taxing the growth on that money. Now, let me just stop right there and pause for just a second. Now, did you catch that? If the penalty for breaking something that has a lot of tax advantages, if the penalty for exceeding that maximum is to be treated like a tax-deferred plan, which one of those is better? I can answer that for you. Normally a penalty is a punishment, right? So the one that does not exceed the modified endowment contract, that stays underneath that max line, that would be better. Now, below the max line has tremendous benefits we're going to talk about. But you could see like a term would be kind of a renting of a life insurance. That would be a minimum price that could be paid. A maximum efficient would be it would be built on the chassis of a permanent life insurance contract, like a whole life insurance contract from a mutual company is who we would use. A mutual company just gives the owner of that policy ownership into the life insurance company's whole book and profit. And so term would be similar to renting a house versus buying a house. Renting a life insurance contract for a time period versus buying a life insurance product for a life. So renting is the most profitable for the insurance company because 98.5% of policies expire based on that term expiration before the people expire. That means that the profit goes to the insurance company. The whole life insurance contract is less profitable for the insurance company, but it's actually very profitable and very beneficial for the individual contract owner. And what I'm going to talk about is not just death benefit. I want to talk about living benefits. Things like tax-deferred growth. This up here, below the neck, can get tax-deferred growth. Tax-free distribution of money. Competitive returns on money. High contribution rate. It can be designed so that you can put whatever amount of money into it that you're wanting to. High contribution rate. There's not a limitation like there are on many qualified plans. There's not a limitation of how much per year you could put into that contract. High contribution allows the individual to determine how much they're wanting to stick away towards the long-term living benefit planning. Additional benefits. There can be benefits like protections from long-term care costs. There can be protections embedded in there for waiver premium, which can protect from disability income needs. There can be critical care costs. There can be the ability to have collateral opportunity. Collateral opportunity means that based on the value you have in that contract, that life insurance policy, you can collateralize against it and use the money elsewhere. It is a tier 1 asset in your asset class for your personal assets. It can give safe harbor protection from lawsuits, judgments, and creditors. It can give you a no-loss provision. It can be protected from downside risk. It can never go down in value. It can give you guaranteed loan options, and that means that the insurance company will actually guarantee to loan you, collateralized by the cash value that you have in that policy. They will guarantee to loan you money to use however you want to use. There's not a qualification process. You send in a 2-page form that has about 4 lines filled out, and you say, I'd like a loan. And they ask how much, and you say this much, and they go, okay, we're going to send you a check, or do you want us to EFT that to your bank account? And guaranteed loan options. Unstructured loan payments. That means that you control the loan process, you control the loan repayment. If you want to pay, that loan back with 10% interest, you can pay that loan back with 10% interest. If you want to pay that loan very fast, you can pay that loan very fast. If you want to pay that loan very slow over the next 10 years, you can pay it back over the next 10 years. If you want to defer the payment on that loan for 6 months while you're into an investment project, you can defer that loan payment as long as you want because you're in control of that loan. Liquidity, use, and control of money. It gives you liquidity, use, and control. That's a powerful thing. Now, let me ask you, all of these things look very different than the discussion about death benefit, right? These are life insurance, which has a lot to do with living benefit, right? Life insurance. And so the key, when you understand this maximum, when you understand modified endowment contract, when you're working with someone who really knows how to work with these type of strategies, is we're able to actually engineer to minimize the death benefit component of a policy and maximize the living benefit components of that policy to expand all of these and at the same time create and embed in the policy the ability to have what's called an increasing face value that holds that policy still below the MEC line, the modified endowment contract line. That increasing face value means increasing death benefit. So based on the more we put into living benefit components, the bigger the death benefit multiplies on those dollars. And so a policy may start with a $500,000 face value or death benefit, and it may increase over a lifetime to pass on a death benefit of $2 million. So if you stuck $1 million into living benefit components and you could pass on $2 million and you started with $500,000, would that be better? That would be really good, right? Yes. So the key with that is to build and create a maximum efficient contract staying below the lines of the modified endowment contract. And so our specialty with MPG Wealth and with being a authorized practitioner of the infinite banking concept is to engineer the living benefit component, minimizing death benefit component of a policy, expanding the increasing benefit, expanding the living benefit component, giving guaranteed loan options, privatized banking options for our clients. Any questions that you all have on that can be addressed by getting a hold of us at MPG Wealth or John at mpgwealth.com.